Looking at the implied open this morning, S&P futures are barely holding water, up a marginal 0.2%, and the Dow is actually sliding down 0.3%. It is Monday, June 8, 2026, and the tape today is just flashing structural damage after Friday's brutal tech liquidation.
Yeah, and the overnight session alone has completely fractured the prevailing market narrative. We are looking at a highly confidential institutional strategy brief today, and it outlines a violently chaotic pre-market environment.
Right, because we are facing this massive double whammy of geopolitical shocks and macroeconomic data. The tectonic plates of global finance are shifting right under our feet before the bell even rings.
Exactly. Wall Street is stepping into a crossfire this morning. The easy money assumptions that active traders have just coasted on for months are completely gone.
Which brings up the central conflict we need to solve for you today. With Asian markets in an absolute free fall overnight and U.S. futures fighting for air, are we looking at a minor correction, or are we staring down a structural market flush?
I mean, to answer that, we have to start with the most immediate catalyst. Over the weekend, the April 8 Middle East ceasefire completely broke down.
Yeah, we saw Israel and Iran exchanging direct missile strikes, and concurrently, the U.S. military conducted strikes on Iranian targets in the Persian Gulf.
Right, and from a purely market perspective, that is a severe systemic escalation, and it immediately sent energy markets surging overnight.
Surging is almost an understatement. We saw Brent crude violently spike 4.8%. It's trading right around that 97.69 to 98.76 a barrel range this morning.
And WTI crude jumped over 4.1%, so it's sitting near 95.64. Energy is catching an aggressive institutional bid right now. It's the ultimate safe haven.
Well, it functions as a dual-purpose instrument, right? You get a haven from the geopolitical risk, but it's also a direct hedge against the inflation that inevitably follows an energy shock.
Exactly, yeah. And if you look at ExxonMobil, ticker XOM, it is the prime example in the pre-market today. Their CEO, Darren Woods, was actually on CNBC early this morning.
Oh, right, I saw that. He was confirming that global petroleum demand remains, I think his exact words were, very healthy.
Right, very healthy. And that specific phrasing matters a lot because it tells the market the fundamental floor for oil was already rock solid.
Even before you later on this massive geopolitical premium for the weekend strikes.
Exactly. So the institutional brief outlines a clear bull case for Exxon. If Brent can hold above that $95 mark, Exxon has a breakout target of $155 to $160.
But the bear case is pretty steep if diplomatic channels open up, right? Like if a ceasefire suddenly materializes.
Yeah, if that geopolitical premium evaporates, the brief models a rapid retest of the $140 to $145 support level.
It feels like the geopolitical situation is, it's like a sudden unpredictable weather system hitting an already fragile power grid.
That is a great way to put it because the market was already heavily bleeding. The geopolitical fire is bad, but Friday's data poured absolute gasoline on it.
Right, the May jobs report. The consensus estimate modeled the economy adding, 85,000 to 92,000 jobs? And the actual print came in at an incredible 172,000.
Staggering deviation. And it completely caught everyone off guard.
But wait, let me push back on the institutional logic here. 172,000 people got jobs. As a regular person, that sounds fantastic. Why is Wall Street panicking over a strong economy and people getting hired?
Well, what's fascinating here is the absolute death of the easy money narrative. Traders had spent the entire year pricing in imminent Fed rate cuts, right?
Yeah, assuming the economy was cooling down.
Exactly. But you take an undeniably hot labor market, which means consumers keep spending, and you combine it with oil suddenly threatening $100 a barrel. You corner the Federal Reserve.
Like the cost of capital simply cannot come down in that environment.
No, can't. Traders have completely capitulated on cuts. The futures market is now actively pricing in a 50 basis point rate hike over the next 12 months under Fed Chair Kevin Warsh.
A hike? Wow. And when hikes get priced in, the currency markets just go haywire. We saw the U.S. dollar index, the DXY, smash right through its previous 99.00 to 99.50 range.
Yeah, it broke out above 100. It's sitting at 100.11 right now. And that strength in the dollar directly explains the bloodbath we just saw in Asia overnight.
Because high yields and a surging dollar choke global liquidity, it acts like a giant vacuum cleaner on capital, right?
Exactly. Capital rapidly flees emerging markets to lock in those high, safe U.S. returns. The result overnight was brutal. South Korea's KOSPI plunged 8.3%.
8.3%.
Mm-hmm.
And that triggered their second circuit breaker of the year, didn't it?
Yeah, literally halting the exchange. And Japan's Nikkei 225 lost 3.9%.
And obviously this contagion is bleeding right into the U.S. Open. I mean, despite S&P futures being up that tiny 0.2%, we suffered a massive tech liquidation on Friday.
Oh, absolutely. The Nasdaq plummeted 4.18% and the S&P dropped 2.64%. The brief diagnoses the current U.S. market state as a corrective liquidity trap.
A corrective liquidity trap. So the S&P's 9-week winning streak is officially broken.
It is, and the Nasdaq saw severe value rejection. I mean, it fell from Wednesday's high of 30,807.8 down to close at 29,418.5.
So let's lay out the technical lines in the sand for our listeners today. What are the specific levels they need to watch on their terminals?
For the S&P 500, the critical zone is 7,445 to 7,455. For the Nasdaq 100, the support level is 30,131 to 30,142.
Okay, so if we stay below those zones, the bears maintain absolute tactical advantage.
Exactly. There is very little fresh liquidity underneath to absorb the selling pressure right now.
So a liquidity trap isn't a free-fall cliff. It's more like traders who bought at the top are now trying to run through a muddy field with heavy backpacks. They're just stuck.
Yeah, that captures the friction perfectly. The higher the yield goes, the deeper that mud gets.
But despite that muddy field, there are specific tech stocks trying to sprint through it this morning. Let's look at the pre-market movers fighting the gravity of these high yields.
Right. First up is MRVL Technology, ticker MRVL. They are up 8% in the pre-market.
But that's mainly because they are officially joining the S&P 500 on June 22, right? So passive funds are mechanically forced to buy it.
Exactly. It's a structural bid. But then you have Oracle, ticker ORCL. They got smashed on Friday, but Evercore ISI just raised their price target to $245.
Modeling 89% growth in Oracle Cloud infrastructure. But the big question for their Q4 earnings on Wednesday is if they can actually monetize that massive $533 billion backlog.
Right. Can they physically get the GPUs and power allocations? If they can execute, the bull target is $230 to $245. If they hit bottlenecks, the bear case is $190 to $200.
We are seeing a very similar tension with Adobe, ticker ADBE. Ahead of Thursday's Q2 earnings, Citi raised its target to $264.
Yeah, they are heavily supported by that $25 billion buyback, but they really need to prove their Firefly AI monetization can outpace pricing pressures.
So the bull target for Adobe is 264 to 280, while the bear target risks a fall to the 225 to 235 zone.
And just briefly looking beyond tech, Eli Lilly is up 4% on obesity drug trial data for Foundayo and retatrutide. Plus, Citi Technology up 22% on a $35 million private placement.
But here's where it gets really interesting. If Oracle and Adobe's valuations rely so heavily on cheap money to fund massive AI data centers, how can they hit these bull targets with the 10-year yield breathing down their necks at 4.58%?
They struggle to, honestly. And that's the exact question retail investors are getting completely wrong right now.
Which brings us to the most urgent institutional warning in this brief. They are outlining what they call the pain trade of 2026.
Right. Retail investors are structurally positioned for a soft landing, a weaker dollar, and Fed rate cuts to fuel the AI trade.
But the brief warns that if the 10-year continues past 4.60%, the ultimate pain trade is a strong dollar high-yield regime.
Exactly. And the brief breaks this down into three pillars of pain. The first is the dollar short squeeze.
Wall Street was heavily shorting the dollar, expecting rate cuts.
Right. Yes. But the breakout above 100 triggers massive panic buying to cover those shorts, which literally drains global liquidity.
Wow. And the second pillar is the long-duration bond trap. Retail piled into long-duration Treasury ETFs, like TLT, expecting a pivot.
But as yields head toward 4.80%, those portfolios face absolutely severe losses.
Which brings us to the third pillar, convexity hedging. This is complex. So spiking yields force mortgage-backed security durations to extend, right?
Yes, because nobody refinances or moves when rates spike. The expected life of the mortgage stretches out.
And that forces institutional managers to mechanically dump longer-dated treasuries to balance their risk.
Exactly. They have to short those treasuries to hedge the duration risk, which cascades the yield spike even further.
So retail investors are sitting at the table playing checkers, assuming the Fed will just cut rates and save the AI trade, while the bond market is playing 3D chess, mechanically forced to sell everything as the dollar squeezes them out.
That is exactly the dynamic playing out pre-market.
Let's recap this deep dive for you. We are looking at a market caught between a massive geopolitical energy shock pushing Brent past $97 and a hot jobs report spiking yields to 4.58%.
It is a brutal liquidity trap, shifting power completely from the tech bulls to the dollar and energy bears.
Whether you are actively trading S&P futures around that 7,445 line in the sand, or just wondering why your tech portfolio is bleeding, you now know the macro tectonic plates moving underneath the surface.
And if we connect this to the bigger picture, I want to leave you with a final thought to mull over. We know Wednesday brings the crucial June 10 CPI print.
Right, which is already expected to rise to 4.2% year over year.
But considering the geopolitical oil spike we just saw over the weekend hasn't even factored into that May data yet, what happens to this fragile liquidity trap when the real inflation shock hits the tape next month?
A terrifying and deeply fascinating question. Thank you for joining us on this deep dive. Keep your eyes locked on the tape, and we will catch you next time.